What if I told you that the entire American financial system, the money in your wallet, the loans you take out, everything, was designed by 6 men on a secret island, all under the cover of a duck hunting trip? It sounds like a conspiracy theory, but it's true. In 1910, a secret meeting of the world's most powerful financiers laid the groundwork for what would become the Federal Reserve. The story of how they did it is a wild ride of crisis, conspiracy, and unbelievable power. And it all starts not on some remote island, but in the chaos of a nationwide panic that brought America to its knees. Chapter 1. The Problem: A Nation on the Brink. To understand the secret, you first have to understand the chaos that made it necessary. In the late 19th and early 20th centuries, America was booming. Steel mills, railroads, Gilded Age fortunes popping up overnight. But underneath all that glitter, the nation's financial system was built on a house of cards. It was a fragile, decentralized mess of thousands of individual banks with no one in charge. And this system had two huge, crippling flaws. First, it didn't have an elastic currency. The money supply was pretty much fixed. So when the economy needed more cash, like during the fall harvest when farmers had to pay their workers, or around the holidays when everyone was shopping, the supply couldn't keep up. Interest rates would skyrocket, credit would evaporate, and the whole economy would grind to a halt. The second flaw was that there was no lender of last resort. When a crisis hit and people panicked, they'd rush to the bank to pull out their money. This is a bank run, and there was no institution that could step in and provide emergency cash to good banks that were just temporarily short. Instead, banks kept their reserves scattered all over the country. When a panic started, country banks would demand their money back from city banks, which had often already lent that money out. One domino would fall, then another, and a small-town scare could explode into a nationwide meltdown. This wasn't just a theory. Financial panics were a regular, brutal part of American life, hitting about every 15 years. There was the Panic of 1873, the Panic of 1893, and another in 1896. Each time, it was the same story. Banks failed, businesses went bankrupt, and millions of ordinary people lost their jobs and their life savings. The system was a ticking time bomb, and in 1907, it finally blew up. The Panic of 1907 started with a classic Wall Street blunder. A couple of ambitious financiers tried to corner the market on the stock of a copper company and failed spectacularly. The banks that funded them immediately looked shaky. The first domino to fall was the Knickerbocker Trust Company, New York's third-largest trust. On October 22, 1907, a terrified crowd swarmed its doors, demanding their money. By the end of the day, the Knickerbocker was drained and had to shut down. Fear, once it's unleashed, is nearly impossible to stop. The Knickerbocker's collapse sent a shockwave of terror through the financial world. The panic spread from New York across the nation as banks started pulling their reserves out of the city, fearing the worst. The stock market cratered, falling almost 50% from its peak the year before. Credit vanished. The financial heart of the country had stopped beating. With the federal government basically powerless, the job of saving the entire U.S. economy fell to one man: John Pierpont Morgan. J.P. Morgan was, for all practical purposes, a one-man central bank. From his magnificent library on Madison Avenue, the 70-year-old titan took command. He summoned the presidents of New York's biggest banks, poring over their books to figure out who was solid and who was bust. He strong-armed his fellow bankers into pledging their own fortunes to prop up the system. In one legendary move, he literally locked the presidents of the major trust companies in his library, refusing to let them leave until they agreed to cough up millions for a rescue fund. By 5 a.m., they signed. Morgan, through sheer force of will, had broken the back of the panic. Morgan was hailed as a hero. But in the aftermath, a chilling thought settled in. What happens when Morgan's gone? Can a modern economy really depend on the health and goodwill of a single aging billionaire? Even the New York bankers, who had always hated the idea of a central bank, now knew they couldn't handle a bigger crisis on their own. The panic had exposed the fundamental weakness of America's financial system. Everyone agreed something had to be done. The question was, what? And who would do it? Chapter 2. The Secret Mission. The Duck Hunt on Jekyll Island. The answer came from Senator Nelson Aldrich of Rhode Island. Aldrich was one of the most powerful politicians of his day, the head of the Senate Finance Committee, and a man they called the general manager of the nation. He was a staunch conservative, an ally of big business, and not coincidentally, the father-in-law of John D. Rockefeller, Jr. After the 1907 panic, Congress created the National Monetary Commission, put Aldrich in charge, and told him to go figure out how to fix America's banking system. For 2 years, Aldrich and his commission toured Europe, studying the great central banks of England, France, and Germany. He came back convinced America needed one too. But he had a huge political problem. In America, the words central bank were toxic. They brought up images of a shadowy money trust, a cabal of Wall Street bankers controlling the nation's economy for their own benefit. This suspicion was especially strong among the farmers and progressives of the South and West. Aldrich knew that if any reform plan was publicly linked to Wall Street, it would be dead on arrival. But he also knew he couldn't design a working plan without the help of those exact same bankers. He was stuck. So in the fall of 1910, he made a radical decision. He would gather a small, top-secret group to draft the bill. The guest list was a who's who of American finance. First, there was Aldrich himself, the political mastermind, and his private secretary, Arthur Shelton. Then came A. Piatt Andrew, the Assistant Secretary of the Treasury, to represent the government. From the banking world, he invited Henry P. Davison, a senior partner at J.P. Morgan & Company. Then there was Frank A. Vanderlip, the president of National City Bank of New York, what we know today as Citibank. And finally, Paul M. Warburg, a partner at the investment firm Kuhn, Loeb & Co., and an immigrant from a powerful German banking family. Warburg was the intellectual of the group, a man obsessed with America's flawed system, who had a deep knowledge of European central banking. These men controlled a staggering amount of the world's wealth. Their mission: design the future of American money and do it in total secrecy. The cover story was a duck hunting trip. The destination? The Jekyll Island Club, off the coast of Georgia. It was described as the richest, the most exclusive, the most inaccessible club in the world. A private winter getaway for families like the Morgans, Vanderbilts, and Rockefellers. In late November, it would be totally deserted. The perfect spot for a secret summit. Their travel plans were straight out of a spy novel. Aldrich told the men to show up one by one to a train terminal in New Jersey, where his private railcar was waiting. He warned them to dodge reporters and pretend they were strangers if they bumped into each other. On the train, the secrecy got even tighter. So the staff wouldn't learn who they were. They agreed to only use their first names: Nelson, Harry, Frank, Paul, and Piatt. For decades, they'd privately call themselves the First Name Club. To keep up the duck hunt charade, Paul Warburg, a man who had famously never fired a gun in his life, was carrying a brand new shotgun. After a 2-day trip south, they arrived on the island, completely cut off from the outside world. No reporters, no telegraphs, no prying eyes. For the next 9 days, these men would have the exclusive run of the Jekyll Island Club. Their task was to lock themselves in a room and not come out until they had a blueprint to control the nation's money. Chapter 3. The Plan. Forging America's Financial Future. The group arrived on Jekyll Island for Thanksgiving week, 1910. The massive clubhouse, usually buzzing with America's elite, was eerily quiet. They weren't there to relax. They were there for 9 straight days of grueling work. They argued and debated day and night, hammering out the details of a new financial system for America. The intellectual engine of the whole operation was Paul Warburg. Having grown up in Germany, he'd seen how a central bank brought stability to the economy. He thought America's system was primitive and dangerous, and he'd been shouting it from the rooftops for years. Now, finally, he had an audience that would listen. The other bankers, like the pragmatic Vanderlip and the powerful Davison, used their real-world experience to challenge Warburg's theories and shape them into a plan that could actually work in America. All the while, Aldrich, the savvy politician, was guiding the discussion, always thinking about how to sell this thing to a skeptical Congress. They started with the big problems. First, the inelastic currency. They needed a financial fire hose, something that could pump money into the system to put out the flames of a panic. Their solution was a new kind of currency, one not just tied to government bonds. It would be backed by gold and short-term business loans, This would let the money supply expand when the economy was hot and contract when it cooled down, giving it the elasticity it so desperately needed. Next, the lack of a lender of last resort. Their new institution would be a banker's bank. Regular banks would keep a portion of their reserves there. Then, if a bank ever faced a run, it could borrow from the central institution to meet its depositors' needs. In theory, this would make bank runs a thing of the past. The thorniest question was control. How do you design this powerful new entity without feeding the public's fear of a central bank? Warburg wanted a single, powerful bank like the ones in Europe, but Aldrich and Vanderlip knew that was a non-starter. Americans hated concentrated power, especially in Washington or New York. So they came up with a uniquely American compromise. Instead of one central bank, they proposed a system of regional reserve banks scattered across the country. Their proposal, which became the Aldrich Plan, called for a National Reserve Association with 15 branches. Each branch would be owned and run by the private banks in its district. This decentralized structure was a brilliant piece of political strategy, designed to calm populist fears of a money trust. The National Board in Washington would have representatives from the branches and a few government appointees. Even the name, the National Reserve Association, was carefully chosen to avoid the toxic phrase, central bank. After 9 days, it was done. The 6 men had a detailed blueprint to completely remake the American financial system. They had arrived as individuals and left as co-conspirators, bound by their secret. They swore to one another they would never admit the meeting took place. As Frank Vanderlip later wrote, if it was ever exposed that our particular group had gotten together and written a banking bill, that bill would have no chance whatever of passage by Congress. They returned to New York and Washington, carrying the plan they believed would save the American economy from itself. Chapter 4. The Betrayal and the Rebirth. From Aldrich Plan to Federal Reserve Act. In January 1911, Senator Aldrich, playing his part as the public face of the operation, presented the Jekyll Island Blueprint to Congress. It was now officially called the Aldrich Plan. It proposed the National Reserve Association, a privately controlled entity with 15 branches to serve as the nation's central banker. The reaction was immediate and vicious. Despite the clever decentralized structure, opponents saw right through it. They knew it was a plan designed by and for Wall Street. Progressives from both parties blasted it as a giveaway to the money trust. The great populist orator William Jennings Bryan claimed it was a scheme to cement the power of the Eastern financial elite. Aldrich's own deep connections to bankers made him the worst possible salesman for the bill. The timing couldn't have been worse. The progressive movement was at its peak, and the 1912 presidential election split the Republican Party. This handed the presidency and Congress to the Democrats and their reform-minded leader, Woodrow Wilson. The Aldrich Plan, a product of a Republican and his Wall Street friends, was officially dead. It seemed the secret mission to Jekyll Island was a total failure. But ideas are harder to kill than bills. When President Wilson took office in 1913, the need for banking reform was more urgent than ever. The Democrats needed their own plan, one free from the taint of Aldrich and Wall Street. The job fell to Congressman Carter Glass of Virginia and Senator Robert Owen of Oklahoma. Glass, a fiery Southerner, was deeply suspicious of concentrated financial power. His first idea was a radically decentralized system of 20 separate regional banks with no central authority at all. He was terrified that any central board would be captured by either politicians or bankers. President Wilson, however, knew some central oversight was necessary. He and William Jennings Bryan insisted that the controlling body had to be a public institution, appointed by the president and accountable to the government, not private bankers. This was the game changer. The debate was no longer about whether to have a central bank, but about who would control it. As Glass and Owen started drafting their own bill, they ran into the same thorny technical problems the Jekyll Island crew had faced. How should the new currency work? How should reserves be managed? In their search for answers, they found themselves, maybe a little reluctantly, turning back to the expertly crafted Aldrich Plan. The core design from Jekyll Island was just too good to ignore. The Democratic bill, which became the Federal Reserve Act, adopted the same basic hybrid structure. Regional banks overseen by a central board. They took the Aldrich Plan, kept its skeleton, and performed a transplant. They changed the name to the Federal Reserve System. They cut the number of branches from 15 to 12. But most importantly, they flipped the power structure on its head. The central governing body, the Federal Reserve Board, would now be made up entirely of public officials appointed by the president. While private banks still owned shares in the regional feds, ultimate control now rested in Washington, D.C. It was a political masterstroke. It took the technical genius of the Jekyll Island Plan and wrapped it in a progressive package that Wilson could sell to the American people. The bill's passage was a brutal fight. The bankers who had championed the Aldrich Plan were now horrified. They saw government control as a step towards socialism. Frank Vanderlip, one of the original Jekyll Island Six, even testified before Congress to try and stop it. But the political tide had turned. With President Wilson staking his reputation on it, the Democrats pushed the bill through. On December 23, 1913, Woodrow Wilson signed the Federal Reserve Act into law. The United States finally had its central bank. It wasn't the privately controlled version the men on Jekyll Island had designed, but it was built directly on their foundation. The secret meeting hadn't failed after all. In a strange, ironic twist of fate, the duck hunt had succeeded beyond their wildest dreams. Chapter 5: The Legacy. A Century of Power and Controversy. The creation of the Fed wasn't the end of the story, it was the beginning. The institution born from a secret island meeting and a Washington political fight would become the most powerful financial entity on Earth. So what is its legacy? And how does that decision from over a century ago still affect you? The Fed's main job was to fix the old system, provide an elastic currency, and act as a lender of last resort. And in many ways, the Fed we know today does just that. It manages the money supply, regulates banks, and tries to keep the financial system stable. The interest rate on your mortgage, your car loan, and your credit card is heavily influenced by a small group of people at the Federal Reserve. But has it been a success? That's a deeply divisive question. The Fed's supporters say that, for the most part, it's brought stability. We still have booms and busts, but we haven't had the kind of nationwide, panic-driven bank failures that were so common before 1913. They point to the Fed's actions during the 2008 financial crisis and the COVID-19 pandemic as proof that it can prevent a total economic collapse. Critics, however, paint a very different picture. They argue the Fed failed at its most basic job, protecting the value of money. Before the Fed's creation, the US dollar had its ups and downs, but there was no steady, long-term decay of its value. Since 1913, the dollar has lost well over 96% of its purchasing power. Critics say that by creating a system of fiat money not tied to gold, the Fed has overseen a century-long policy of currency debasement. What's more, the Fed has been accused of not preventing, and sometimes even causing, the very crises it was meant to stop. The famous economist Milton Friedman argued that the Fed's terrible mismanagement of the money supply was a primary cause of the Great Depression. More recently, critics blame the Fed's low-interest rate policies in the early 2000s for inflating the housing bubble that led to the 2008 global financial crisis. And then there's the issue that was there from the very beginning: secrecy and accountability. The men on Jekyll Island were terrified of public scrutiny, and that culture of opacity has lingered. The Fed is designed to be independent, shielding it from short-term political whims. Supporters say this is crucial for making tough economic decisions. But critics ask, independent from whom? They argue the Fed is still too close to the big banks it is supposed to regulate. A direct legacy of the men who wrote its DNA. Debates about auditing the Fed are still raging today, echoing those old populist fears of an unaccountable money trust. The parallels between 1907 and today are striking. The panic of 1907 was kicked off by unregulated shadow banks. The 2008 crisis was also triggered by shadow banking entities. In both cases, a fire that started on the fringes of the financial system threatened to burn the whole thing down. The fundamental problems of financial panics and systemic risk that the men on Jekyll Island tried to solve are still very much with us. The story of the Fed's creation is a crucial piece of our history, showing how secret decisions can shape the world for a century. If you found this dive into the hidden history of money interesting, hit that subscribe button and ring the bell so you don't miss our next investigation. But more importantly, let us know what you think in the comments. Has the Federal Reserve been a force for good, or did this secret meeting kick off a century of problems? Is it a vital pillar of stability or an engine of inflation? We read all the comments and want to hear your take. Before the conclusion, I'd like to show you something. When you picture the Federal Reserve, this might be what comes to mind: a temple of money, crowned with classical columns, power carved in stone. But in reality, the Federal Reserve's headquarters in Washington, D.C. looks nothing like that. No pediment, no marble gods, just austere lines and quiet power. The confusion comes from its neighbor, the Treasury Building, which does have that classical temple roof. Artists have blended the two for decades. Why? Because that shape, the temple facade, is shorthand for authority, secrecy, and permanence. It feels ancient, untouchable, a perfect fit for the myths surrounding the Federal Reserve. But the real power of the Fed isn't in its facade. It's in the decisions made inside. Decisions that ripple across every wallet, every market, and every country. And now, the conclusion. From a secret duck hunt on a Georgia island to the marble halls of Washington, D.C., the birth of the Federal Reserve is a story of how power, crisis, and intellect can reshape a nation. 6 men, at the peak of their power, saw a system about to break and took it upon themselves to fix it. Their motives were a complex mix of public service and self-interest, a real desire for stability, and an instinct to protect their own world. The plan they wrote in secret was defeated in public, only to be reborn in a different form, a testament to the power of their ideas. The institution it created is a paradox, a public-private hybrid, independent yet accountable, a source of stability and a target of controversy. It stands today as a direct descendant of the plan dreamed up on Jekyll Island. The story of Jekyll Island is more than just a historical footnote. It's a powerful reminder that the forces shaping our world often operate just out of view. The money in your pocket, the interest rate on your loan, the financial stability of your life. It's all connected by a long thread, leading back to the decisions made by 6 men on a secret island, who in just 9 days laid the foundation for a new era of American power.